The investing industry is worth trillions of dollars. It employs hundreds of thousands of highly educated people. It produces research and analysis and strategies and products of extraordinary complexity. And the data shows, consistently and without exception across every time horizon studied, that the simpler you make your investing, the better your results will almost certainly be. Yemi spent 4 years trying to invest the way the industry told him to. He had a portfolio of 11 individual stocks he had researched carefully. He had 2 actively managed funds recommended by a financial advisor. He had a sector-specific fund targeting technology because he had read that technology was the future. He checked his portfolio 4 times a week and made adjustments when things moved in ways he did not expect. After 4 years, Yemi compared his results to a single index fund that tracked the entire market. The index fund had done nothing for 4 years except exist. No research, no adjustments, no advisor, no sector bets. It had simply sat there and captured whatever the market produced. The index fund had outperformed Yemi's carefully managed portfolio by 3.8% per year. Not in one bad year, on average across 4 years. Yemi had worked harder at investing than almost anyone he knew, and a fund that required 0 effort had beaten him by nearly 4% annually. Today we are going to look at exactly why this happens. What is actually inside an index fund, and why the simplicity is the feature rather than the limitation. And why one index fund, chosen carefully and held patiently, is genuinely all most people will ever need. To understand why one index fund works so well, we first need to understand what is actually wrong with the way most people invest. And the problem is not that they are unintelligent or uninformed. The problem is that they have been taught to think about investing in a way that makes the financial industry money, not a way that makes them money. The financial industry profits from activity. Every trade generates a fee. Every managed fund charges an annual expense ratio. Every advisory relationship charges a management fee. Every new product launched requires someone to buy it. The industry is structurally incentivized to keep you busy, to make investing feel like something that requires constant attention and expert management and regular adjustments. But the data on investment returns tells a completely different story. The more actively a portfolio is managed, the worse it tends to perform over time. This is not a controversial finding. It has been replicated across decades of research across multiple countries and multiple market conditions. Activity in investing is almost always expensive and almost always counterproductive. The reason for this is not that fund managers are incompetent. Many of them are extraordinarily skilled analysts. The reason is that markets are extraordinarily efficient at incorporating available information into prices. When millions of sophisticated participants are all looking at the same information and trading on it simultaneously, the opportunity to systematically outperform the collective wisdom of all those participants is very small and very temporary. A study published by S&P Dow Jones Indices, one of the most comprehensive ongoing studies of active fund performance in existence, found that over any 15-year period, approximately 88% of actively managed large-cap funds underperform a simple passive index. 88%. The professional fund managers with their research teams and their proprietary models and their decades of experience. 88% of them fail to beat an index that is doing nothing except holding everything. This is the central paradox of modern investing. The more effort and expertise you apply to the process, the more likely you are to underperform the option that requires neither effort nor expertise. Complexity is not an advantage. It is almost always a cost. Yemi understood this intellectually before he experienced it. Most people do. But understanding it intellectually and actually believing it deeply enough to act on it are two different things. because the idea that doing nothing, or as close to nothing as possible, is the optimal investment strategy feels profoundly uncomfortable in a culture that equates effort with reward. So what actually is an index fund, and why does holding one broad market index fund outperform the vast majority of more complicated approaches? An index fund is a fund that holds every company in a specific index in proportion to each company's size. A total market index fund holds every publicly listed company in the market, from the largest corporations to the smallest listed companies, weighted according to their market capitalization. When you own 1 unit of a total market index fund, you own a tiny fraction of every publicly listed business in that market simultaneously. Think about what this means in practical terms. You do not have to decide which companies will win. You do not have to predict which sectors will grow. You do not have to research earnings reports or management quality or competitive positioning. You own all of it. Every winner that emerges anywhere in the market automatically becomes part of your portfolio as it grows. Every company that fails gradually shrinks in your portfolio as its market value falls and is eventually replaced by something better. The index is self-cleaning. That is the feature most people miss when they first encounter it. Failing companies shrink and eventually disappear from the index. Growing companies expand and eventually dominate it. The portfolio constantly and automatically migrates toward what is working without any decision required from you. You are not picking winners. You are owning the entire competition and collecting your share of whatever the winning produces. Yemi had spent 2 years researching individual companies before he understood this. He had been trying to identify the future winners and exclude the future losers. But the index fund had already solved that problem, not by predicting which companies would win, but by owning everything and letting the market's own verdict determine the weight of each company in the portfolio over time. The cost advantage of an index fund compounds this structural advantage significantly. A typical actively managed fund charges between 0.5 and 1.5% of your invested assets per year in management fees. A broad market index fund charges between 0.03 and 0.1%. The difference sounds small. It is not small over time. On a $200,000 portfolio, the difference between a 1% fee and a 0.05% fee is $1,900 per year. That $1,900 does not just disappear, it also stops compounding. Over 20 years, the fee difference on a growing portfolio can represent more than $100,000 in foregone wealth. You are not just paying a fee. You are paying a fee and then paying again in all the growth that fee would have generated if it had stayed invested. The index fund wins on structure. It wins on cost. And as Yemi discovered, it also wins on the one variable that most investment analysis ignores almost entirely: the behavior of the person doing the investing. The behavior gap is the difference between the return an investment produces and the return the investor actually receives. And it is one of the most important and least discussed concepts in personal finance. An investment can produce 10% per year on average over 20 years. But if the investor sells during downturns and buys during recoveries, which is what most investors do because it is what fear and greed naturally produce, the investor might receive 6 or 7% of that 10%. The investment did its job. The investor's behavior eroded the result. Research by the financial data firm Dalbar has tracked this gap for decades. Their annual study consistently finds that the average equity fund investor underperforms the average equity fund by between 2 and 4% per year. The fund produced 10%. The investor received 7%. The gap is entirely explained by the timing of their entry and exit decisions driven almost entirely by emotional responses to market movement rather than rational analysis. A single broad market index fund reduces the behavior gap in a specific and important way. When you hold one fund that represents the entire market, there is nothing to switch between. There is no other fund that looks more attractive when yours is falling. There is no sector rotation strategy to implement when technology is down and energy is up. There is nothing to do except hold what you have. Yemi's 11-stock portfolio gave him 11 opportunities per week to second-guess himself. If one stock fell 15% while the others were flat, he had an immediate visible problem demanding a decision. Should he sell and cut the loss? Should he buy more because it is now cheaper? Should he hold and hope? Every decision point is an opportunity for emotion to override reason. And with 11 stocks, there were always decision points. With one index fund, there are no individual company decisions to make. The fund falls during broad market downturns and rises during broad market recoveries. And both of those things happen to every investor simultaneously regardless of what they own. There is no individual stock falling while everything else is up. There is no trigger for the specific kind of anxious second-guessing that erodes returns one bad decision at a time. The index fund is not just a better investment. It is a better environment for the human being doing the investing. It removes the variables that activate the worst instincts. And in doing so, it allows the investor to actually receive something close to the return the market produces rather than a fraction of it filtered through fear and overreaction. Now let us address the most common objection to the one-fund approach. And it is an objection that sounds sophisticated but does not survive contact with the actual data. The objection is this. One fund is fine for average investors, but for people who are willing to do the work and research properly, a more sophisticated approach should produce better results. The premise is that skill and effort should translate into outperformance. And it is a premise that feels deeply reasonable. The problem is that the data does not support it at the individual investor level. Individual investors who spend more time on investment research do not tend to outperform those who spend less. In fact, several studies have found a slight negative correlation. The more time an individual investor spends researching and adjusting their portfolio, the worse their average returns tend to be. Not because research is bad. Because research leads to more decisions, and more decisions leads to more opportunities for behavioral error. Yemi is a thoughtful and intelligent person. He reads financial analysis carefully. He understands business fundamentals. He tracks macroeconomic trends. None of this translated into investment outperformance because the market he was investing in was full of other thoughtful, intelligent people who also read financial analysis and tracked macroeconomic trends. His edge, if he had one, was being competed away by everyone else who had the same edge simultaneously. The one exception to this pattern is genuine informational advantage, knowing something material about a company or a market that other participants do not know. But for individual investors operating legally, this type of advantage is essentially unavailable. You cannot legally trade on non-public information. And all publicly available information is already reflected in the price by the time you read it. The honest conclusion of 50 years of academic research on this question is that for the overwhelming majority of individual investors in efficient markets, a single low-cost, broadly diversified index fund held over a long time horizon will produce better results than any more complicated approach they are likely to implement. Not because complex approaches cannot work in theory, because they require a level of consistent execution and emotional discipline that very few human beings can sustain across decades of market cycles. Yemi switched to one index fund after his 4-year experiment. He chose a total market fund with an expense ratio of 0.04%. He set up a regular monthly contribution. He removed his portfolio from his phone's home screen so he would not check it reflexively. and he resolved to look at it once per quarter and do nothing unless his life situation had changed significantly. The final thing we need to address is the question of which one fund. Because not all index funds are created equal, and choosing the right one matters more than most beginners realize. Even if the choice itself is not complicated, the first principle is breadth. The broader the index, the more diversified the fund, and the less exposed you are to any single company or sector having a bad decade. A total market fund that holds thousands of companies across all sectors and all sizes is more resilient than a fund that tracks only the 500 largest companies. And both are vastly more resilient than a sector fund that bets on one part of the economy. The second principle is cost. The expense ratio of the fund is the one variable you can control with certainty. Market returns are uncertain. Your behavior is uncertain, but the fee is fixed and it compounds against you every single year. Look for a fund with an expense ratio below 0.1%. Anything above that is a cost you are paying for a service, active management, that the data shows you are very unlikely to benefit from. The third principle is structure. In most countries, you can hold an index fund inside a tax-advantaged account, a retirement account, or an equivalent, which means the growth compounds without being reduced by annual capital gains taxes. The combination of low cost inside a tax-advantaged wrapper is the most efficient structure available to most individual investors. It requires no ongoing management. It requires no expertise to maintain, and it outperforms the vast majority of alternatives. Yemi spent more time choosing his one fund than he had spent researching any individual stock in his previous 4 years of investing. He read the fund documentation. He compared expense ratios across providers. He confirmed the fund held the breadth of market he wanted. And then he made the decision once and committed to not making it again unless his circumstances changed fundamentally. That is the final and perhaps most important point about the one fund approach. It is not a passive decision in the sense of being uninformed or careless. It is an active decision made carefully and deliberately to stop making active decisions after that. The research goes into the initial choice. The discipline goes into leaving the choice undisturbed. And the reward comes from the compounding that the undisturbed choice produces over time. So here is the full picture of what we covered today. The investing industry is structurally designed to keep you busy because busy investors generate fees. But the data consistently shows that investment activity is almost always a cost rather than a benefit. 88% of professional fund managers fail to beat a passive index over 15 years. The average individual investor underperforms their own funds by 2 to 4% annually through emotional timing decisions. Complexity does not produce better results. It produces more opportunities for things to go wrong. An index fund works because it owns everything and lets the market determine the winners over time. It is self-cleaning. Failing companies shrink and disappear while growing companies expand and dominate, without any decision required from you. Its cost advantage over actively managed funds compounds into hundreds of thousands of dollars of difference over a long investment horizon. And it removes the individual decision points that activate the behavioral errors that destroy most investors' real returns. Choosing one fund is not a compromise for people who cannot afford a financial advisor or do not have time to research properly. It is the conclusion that the evidence points toward for almost every individual investor operating in an efficient market. The people who understand investing most deeply are often the ones most willing to own the simplest possible portfolio, because they have seen the data and the data is not ambiguous. Yemi has now held his one fund for 6 years. He has not sold during any of the 3 significant market downturns in that period. He has not switched to a different fund when a different sector looked more attractive. He has not added complexity when friends told him about more sophisticated strategies. He has simply held what he chose and contributed to it consistently. And his 6-year return is comfortably ahead of where his 11-stock portfolio would have taken him, with a fraction of the time and none of the anxiety. If you are currently investing in multiple funds or individual stocks or actively managed products, take one afternoon this week and look honestly at your actual returns compared to the total market index over the same period. Not the returns you remember, your actual returns. Look at the numbers without narrative. And then ask yourself whether the complexity you are managing is producing results that justify its cost, in fees and in time and in the emotional energy it takes to maintain it. Share this video with one person who is either avoiding investing because it feels too complicated or managing a complex portfolio that is keeping them anxious. Because the answer to both situations is the same. One fund, chosen carefully, held patiently. That is the complete strategy. I will see you in the next one.